It doesn't start when you think it starts. Not when you open your first bank account. Not when you get your first paycheck. Not even when you make your first investment. By the time you arrive, the clock has already been running. And some people, they've been on that clock for years. Imagine two people, same intelligence, same work ethic, same ambition. One starts earning at 25. The other also starts at 25. On paper, they're equal. But here's what you don't see. One of them had access to capital, information, and opportunity 5 years earlier without realizing it. And those 5 invisible years, they don't just add up, they multiply. This is the hidden timing advantage, and it's one of the biggest reasons wealth gaps don't just exist, they expand. Not because some people are smarter, not because others are lazy, but because in money, timing isn't just important. Timing decides everything. Let's slow this down, because most people think money is about effort. You work, you earn, you save, you invest. Simple, linear, fair. But the real system doesn't work like that. It's not linear, it's layered, and more importantly, it's delayed. Money doesn't hit everyone at the same time. It moves in waves, and those waves hit different people at completely different moments. Think about new money entering the economy. Not your salary, not your side hustle. I'm talking about fresh money, newly created money. It doesn't just appear in your bank account, it starts somewhere else, at the top layers of the system. Large institutions, banks, asset holders, entities that are already positioned. They receive it first, they deploy it first, they benefit from it first, and only later, much later, does it trickle down into wages, jobs, and everyday spending. Now here's where timing becomes dangerous, because when money enters early, prices haven't moved yet, assets are still cheap, opportunities are still quiet. There's no hype, no headlines, no urgency, just access. Fast forward, that same money spreads, markets react, prices rise, demand increases, and suddenly everyone notices. Now the average person enters. Now you hear about it. Now it feels like an opportunity, but it's not the same opportunity anymore, because you're not early, you're on time. And in this system, on time is already late. Let's make this more real. Think about property. A new area starts developing. Infrastructure is planned. Maybe a road, maybe a project, maybe a shift in policy. At this stage, almost nobody cares. Prices are low. The risk feels high. Information is limited. But a small group of people moves in early. They buy, they hold, they wait. Years pass. Development begins. Demand increases. The same area now looks promising. Prices rise. More buyers enter. Media starts talking. Now it feels safe. Now it feels obvious. Now it feels like the right time. But the real advantage, it already happened. The early buyers didn't just gain value, they gained time. And time and money compounds. Because while others are just entering, they're already sitting on growth. While others are taking risk, they're managing profit. While others are hoping, they're deciding when to exit. This is the part people miss. Wealth doesn't just come from making good decisions, it comes from making them earlier than others. And here's the uncomfortable truth. The system is built to reward early access, not just smart behavior. You can be disciplined, informed, and hardworking, but if you enter late, your outcomes will be limited. Not because you failed, but because the best part of the cycle already passed. Now let's go deeper. Because timing isn't random, it's structured. Certain people are consistently earlier, not by luck, but by position. They're closer to information. They see signals before they become trends. They hear about changes before they become news. They have access to capital before others even realize there's an opportunity. And that creates a loop. Early access leads to early gains. Early gains lead to more capital. More capital leads to better opportunities. Better opportunities lead to even earlier access. It's not just a head start, it's a compounding advantage. Meanwhile, most people experience the system in reverse. They see results first, then they hear the story, then they try to participate. But by that time, the risk is higher, the upside is smaller, and the timing advantage, gone. This is why financial advice often feels confusing. Invest early, buy low, think long term. It sounds simple, but it ignores the most important factor:
access to timing. Because you can't invest early if you don't see the opportunity early. You can't buy low if prices have already adjusted by the time you arrive. You can't think long-term if you're constantly reacting to short-term movements. So what happens? People chase. They enter during peaks. They exit during fear. They repeat the cycle, not because they're irrational, but because they're delayed. And delay is expensive. Let's talk numbers for a moment. Two people invest the same amount, same returns, same discipline. The only difference is one starts 5 years earlier. At first, it doesn't look like much, a small gap, nothing dramatic, but over time, that gap widens, then accelerates, then becomes impossible to ignore. Because compounding doesn't grow evenly, it grows aggressively, and the earlier it starts, the more violent the difference becomes. Now, combine this with access. The early investor doesn't just grow faster, they unlock better opportunities, private deals, larger investments, lower risk entries. So it's not just that they have more, they have better options. And this is where the system quietly shifts, because once you have options, you're no longer reacting, you're choosing. Meanwhile, the late entrant is still trying to catch up, still trying to identify the next move, still trying to avoid losses. Same effort, different timelines, completely different outcomes. Now zoom out. This isn't just individuals, this is entire economies, entire generations, entire systems. When new industries emerge, who benefits first? The builders, the insiders, the early adopters. When policies change, who adjusts first? Those who understand the system, those who are positioned, those who are already inside. Everyone else, they adjust later, at higher cost, with less upside. And over time, these small timing differences stack, layer over layer, cycle over cycle, until what started as a small gap becomes a massive divide. This is how wealth gaps are created, not overnight, not through one decision, but through repeated timing advantages. And here's the part that makes it even more complex. The system doesn't advertise this. It doesn't say, be early or lose. It says, work hard, stay consistent, be patient. All true, but incomplete. Because effort without timing feels like progress, but often leads to stagnation. And timing without effort, that's where disproportionate outcomes are created. Now here's the irony. The people who benefit from timing often credit skill. The people who miss timing often blame themselves. But both are reacting to the same system, just at different moments. So what does this actually mean? It means the game isn't just about what you do, it's about when you do it, and more importantly, when you're allowed to see it. Because visibility is controlled, access is uneven, and timing is rarely equal. Now pause for a second, because this raises a bigger question. So if timing creates such a massive advantage, why isn't everyone trying to get earlier? The answer is uncomfortable, because being early doesn't feel good. It feels uncertain, it feels risky, it feels lonely. There's no validation, no confirmation, no guarantee. You're moving before the system proves you right. And most people, they don't want that. They want clarity, they want safety, they want confirmation. But confirmation comes late, and late is expensive. So the system quietly rewards those who act without it. Now let's take this one step further, because timing isn't just about entering early, it's also about exiting on time. Another hidden advantage. The same people who enter early often leave early, before peaks, before corrections, before panic. And how do they do that? Because they're not following the crowd, they're ahead of it. They see saturation before it becomes obvious, they feel risk before it becomes visible, they act before it becomes necessary. Meanwhile, late entrants are still entering, still buying, still believing the growth will continue. And when things reverse, they're the ones holding the highest risk. Again, same system, different timing, different outcome. Now here's the part most people never fully process. This cycle repeats over and over. Different assets, different markets, different industries, same structure. Early access, delayed reaction, expanding gap. And every time, the advantage compounds. So the real question isn't how do you work harder, or even how do you invest better? The real question is, how do you stop